So guys, we are knee deep in the middle of earnings season, and so far I've been able to listen to a few different calls. I've gone through Johnson & Johnson's quarterly earnings, Procter & Gamble's, and last but not least, Snap-on's, which is the company we'll be focusing on today because after reporting their Q3 earnings, Snap-on's share price shot up like a rocket. And as we can see on Snap stock over here, just on this one day, on October 17th, Snap-on soared at nearly 10%, going from just under $300 per share to where it's at now, which is an all-time high share price of $326.09. And looking at the overall performance for the month, this is going to leave Snap-on up 15.25%. If we zoom out looking at the year-to-date performance here in 2024, Snap-on is up 17.67%. So most of this stock's gains this year have come just in the last 30 days. And if we zoom out once more over the last year, this is going to leave Snap-on up about 32.5%. Now, while Snap-on's performance has been impressive, we need to look a bit deeper into the company's earnings report, which, like I said earlier, played a major role in the massive jump we saw this week. Starting with the highlights, the company did miss on their revenue expectations, posting a 1% year-over-year decline, which, truth be told, really isn't that bad in my opinion, but they absolutely crushed their earnings estimates, delivering $4.70 in earnings per share for the quarter, which is up 19 cents compared to the same period last year. And from what I can see, this earnings beat was the main catalyst behind the massive share price surge. Despite the slight dip in sales that the company saw, they still managed to grow their earnings per share by 4%. On top of that, the company achieved a record operating margin of 22%, which I think was another major factor behind the positive share price performance. However, circling back to the revenue, all three of Snap-on's key segments saw lower revenue compared to last year. On the earnings call, management discussed several reasons for this, pointing to uncontrollable factors like geopolitical tensions and rising interest rates, which are creating some short-term customer hesitancy. Now, to combat this and to continue driving sales, a key part of Snap-on's strategy has been to focus on shorter payback products like hand tools, for example, which are designed to meet the immediate needs of technicians who might be hesitant to commit to bigger purchases in uncertain times like this. And they're also capitalizing on trends like the aging vehicle population, with the average age of cars in the US now sitting at 12.6 years. As these cars age, they require more frequent and complex repairs, which should continue to drive demand for Snap-on's high-tech diagnostic and repair tools. And with that, it's also worth noting that as of this earnings call, Snap-on is now in a negative net debt position where they have more cash than total debt on their balance sheet. That is a huge plus in my book. And all in all, I think Snap-on is positioning itself pretty well for long-term growth. I think this was another fine quarter for them, and I still feel great about owning this company in my portfolio. In fact, I honestly just wish I had more. And on that note, taking a look at my Snap-on position over here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this spreadsheet in the description of the video. But here, guys, we can see I have just under 9 shares of Snap-on, which, like I said, is not as many as I would like to have. I wish my position was much larger, but I have about 9 shares, and the shares that I do have, there is a pretty sweet cost basis here. My average cost per share is $211.04, which means right now the current share price is over $115 above my cost basis, which is going to leave me with a 54.5% share price return, not too shabby if I say so myself, and a near 63% total return, which makes Snap-on my third best performing position behind Williams-Sonoma here at around 120% and AbbVie at 81.5%. But anyway, guys, with all of that said, the big question becomes, what should you do with Snap-on from here? Is it a buy? Is it just a hold? Should you sell your shares and lock in some gains after this massive run up in share price? Well, jumping back over to Snap stock here, when you look at the free cash flow yield, it's really not at a terrible valuation even after the run up. I think this 8.03% is before the surge in share price. But you know what, guys? We can do a little bit of manual math to find out what the actual free cash flow yield is right now. So if we scroll down looking at the free cash flow per share in the trailing 12 months, it's $22.78. So we can plug that into the calculator right here, and let's scroll back up to get the current share price. 326.09, so we'll divide that 22.78 into 326.09 times 100, and that is going to leave us with a 6.98% free cash flow yield. So we can round up basically a 7% free cash flow yield, which is still a very respectable free cash flow yield. That is not bad at all. And actually, if we also look at the PE ratio and the price to free cash flow, these aren't in bad shape either at 14.4 and 14.3 respectively. So all across the board, I think the valuation still looks fine. But then comparing that with another source, if we look at Alpha Spread's intrinsic values, they give it a base case intrinsic value of 265.32, which means that based on the current share price, it is about 18% overvalued. But With this, alpha spread also gives Snap-on a best case intrinsic value of 367.68, which would mean that it is still 12% undervalued. So that's quite the range there. So overall, maybe it's a decent valuation, not the best, could be better, but it also could be worse. But still, I think if you have a long time horizon, if you plan on just buying and holding your shares for a number of years, I think you'd still fare pretty well with Snap-on because it's still an incredibly solid dividend growth stock. I mean, just spending a little bit of time with these growth metrics, we can see that for all of them, we're missing the data for 2014 and 2020, but otherwise we can still tell that revenue has been trending up over the years for sure. We can definitely see that trend here with the earnings per share at the bottom line. So that's looking really good. And we also see a similar trend here in the free cash flow per share. So like I said, this has been a very solid dividend growth stock. These financials are looking great. And if we scroll down just a little bit looking at the profitability, this is looking fantastic as well. We still don't have that 2014 or 2020 data, but we can tell that the margins are actually increasing over time. In 2015, Snap-on's gross margin was, 48.3%, and now it's up over 50%. In the trailing 12 months, it was 51.3%. So a little bit of progress there, and we can visually see a difference here in the net income margin. In 2015, the bottom line, that net income margin was at about 12.9% compared to today, or in the trailing 12 months, it's now up over 20%. In fact, getting close to 21%. So this is some very nice progress here. And we also see a similar trend in the free cash flow margin going from, just below 10% in 2015 to over 24% in the trailing 12 months. That is quite a big jump, but these are all green flags to me. And now scrolling down just a little bit more, looking at the debt, clearly the net debt has been trending down over the years, which is great to see. And as we saw earlier, Snap-on officially has negative net debt. So the balance sheet is just looking pristine. And now this brings us to the dividend stats. Starting here with the yield, we can see that the dividend yield has been going up over the years, which means that the dividend has actually been growing faster than the share price. And that dividend, guys, has been growing. Let me tell you, looking at the chart right here, this is exactly what you want to see. And both the 5-year and 10-year dividend growth CAGRs are looking pretty sweet. 14.35% for the 5-year, about 15.4% for the 10 years. And with that, if we scroll down just a little bit more, one thing that I do want to point out is this earnings payout ratio right here. We can see that this has been trending up over the years, but that's not necessarily cause for concern yet because we can still see here in the trailing 12 months, the payout ratio is below 40%. So not dire by any means. However, you will want to keep an eye on how this trends from here. If we start to see that payout ratio get upwards of 50% or 60% or potentially even higher, then yeah, that would be a red flag, I think. But if we jump back over here looking at the free cash flow payout ratio, we actually see an opposite trend here. The free cash flow payout ratio looks to be going down over time, and actually in the trailing 12 months is lower than the earnings payout ratio at 32.8%. So that's a good sign. Now, even though right now I'm not buying any more shares of Snap-on, in this next video right over here, I'm telling you about a new stock that I am buying. A few weeks back, I actually started a brand new position in the portfolio, and I'm telling you all about it in this video. So click right over here to check that out, and I'll see you in the next one.